My name is Philip Brown. I'm the Head of Research at FIIG Securities. We are a bond trading house, and my role within the company is, as I say, Head of Research, which helps select the menu of bonds that our company offers to clients. The purpose of the Macro Outlook publication is to help our clients understand the background situation in the economy. Obviously, the RBA changes interest rates every so often, and market interest rates move every day. So if you're trying to create a bond portfolio, you need to understand what's happening in the background in the economy, and that's what the Macro Outlook is trying to help our clients to do. To help them understand what the big questions are in the economy at the moment and how that might affect their investments over the next 6 months, year, 2 years. The really big question in the Australian economy at the moment, as we start 2026, is how much spare capacity is there in the Australian economy? There's been a lot of huge developments over the last few years, and we're seeing the echoes of those coming through now. And what has changed, and why there's been quite a big change between the end of 2025 and the start of 2026, is we're starting to see two things come through. One is a strong recovery in household spending, but the other is this nascent boom in AI investment. That is a good thing. Like, Australia needs more productivity, we need more investment, that needs to happen, but there's not a lot of space in the economy at the moment to do that. The question in 2026 is how much spare capacity is there in the economy, and is any further growth that we see going to trigger inflation? Investors should feel comfortable taking advantage of the very strong returns available, but that does mean that if you're prepared to take a locked-in investment now, you can lock in 6% or even sometimes closer to 7% for comparatively low risk companies. If you lock in a 5-year or 10-year investment now and then the economy gets even stronger, you might find that interest rates sell off even further. If you're concerned about that side and you don't want to lock in an interest rate at the moment, floating rate notes, which pay you an interest rate linked to the cash rate, make excellent sense right at the moment as well. You also need to be aware of all the other risks in the economy and the global economy for that matter, like inflation, credit risk, exchange rate risk, and that's where the RISE strategy, which is what the Macro Outlook is describing, comes into its own. It's about how to balance that desire to make returns whilst almost also managing your risk exposure. Our strategy for 2026 is called RISE. R stands for returns, and just reflects the fact that there is a very high returns available in fixed income at present. I stands for inflation. You need to protect yourself from inflation in all your investments. S is sector diversification. You need to make sure you're properly diversified, so if there's something unexpected does happen, you don't have all your eggs in one basket. And E stands for exchange rate exposure, which is to make sure that if the Reserve Bank is raising rates and the Australian dollar starts moving dramatically, you have your exchange rate exposure where you want it to be. Investors should invest wherever they feel most comfortable, but at present there are excellent returns available in that 7 to 10 year part of the curve. 6%, 6.5% is very achievable in high quality investment grade companies. If you're interested in a long-term investment in something like infrastructure, maybe Transgrid has a 10-year bond which looks very nice sitting in that 10-year sector. The single best bond available at present, in my view, is probably the Sydney Airport 2030 inflation-linked bond. That bond has a very high yield still, CPI plus 3.4%, means whatever inflation is, you get that plus another 3.4%. You'll end up with a company like Sydney Airport, which has a very strong investment-grade credit rating, and it's only a 4-year bond, so there's not a great deal of duration risk either. There are a lot of borrowers and investors around the world who are looking at policy developments in the United States and thinking, I wouldn't mind having a bit of diversification and having exposure in countries and currencies that aren't the US dollar. That has encouraged a lot of companies to set up new Australian dollar borrowing programs, which is providing excellent opportunities for Australian investors who can now access global companies in Australian dollars. There is a lot of opportunity in bond markets at the moment. We think that the right thing for investors to do in that scenario is to look at their portfolio and say, right, well, now's a pretty good time to buy essentially any sort of bond. Get all your other risks under control at a time when it's a good time to buy almost any bond. Of course, we've only sort of scratched the surface with this discussion here, so if you want to get into more detail, read the whole publication, the FIIG Macro Outlook. This year for 2026, it's called Rise.